You look at your bank account and think your money is just sitting there, resting, safe. It is not. We are sitting here in 2026, and inflation has cooled off a little, sure, but life still feels insanely expensive. So you put your money in a savings account because that is what your parents told you to do. You want to be responsible. You want that safety net. But here's the brutal truth. Your bank does not look at your money and see a safety net. They look at your money and see free ammo. Most people think banks are like giant secure storage units. You put your money in, they lock the door, and they charge you a tiny fee for the service. But the math proves it is actually the exact opposite. They're not holding your money. They're renting it from you for pennies, flipping it, and keeping all the profit. And you are paying them for the privilege. I'm Heisenbank, by the way. Welcome back to Breaking Finance. What I'm about to show you today is the actual step-by-step math of how the modern banking machine drains your wealth while convincing you they are doing you a favor. I'm going to show you where your money actually goes the second you deposit it, because once you see the numbers, you can never unsee them. And more importantly, you can stop playing their game and start playing yours. Let's talk about the spread, the 0.01% insult. Right now, in 2026, the federal funds rate is hovering around 3.5 to 3.75%. That's what banks charge each other to borrow money overnight. But what do the big legacy banks pay you for your basic savings account? 0.01%. I am not joking. Go check. Bank of America, Chase, Wells Fargo, 0.01% annual percentage yield. Let's do the brutal math on that. If you have $10,000 sitting in a standard savings account for a whole year, you earn exactly $1. $1. You cannot even buy a piece of gum with that anymore. But what does the bank do with your $10,000? They do not leave it in the vault. They instantly lend it out to someone else. They lend it to your neighbor for a car loan at 8% or a credit card at 24%. Let us be generous and say they lend your $10,000 out as a personal loan at 10% interest. Over that same year, the bank makes $1,000 in pure interest off your money. They make $1,000, you make $1. That gap, that 9.99% difference, that is called the net interest margin, or as I like to call it, the stupid tax, because you're letting them take your capital, take the risk, and pocket the reward. And it gets worse because of something called fractional reserve banking. This is the part that usually makes people want to throw their phones at the wall. When you deposit that $10,000, the bank does not just lend out $10,000. No, they only have to keep a tiny fraction of it in reserve. Historically, it was 10%. Recently, for a lot of banks, the reserve requirement dropped to zero. Zero, meaning they can lend out almost everything over and over again. They take your deposit, lend it out, that borrower buys a car, the car dealership deposits that money into their bank, and that bank lends it out again. It's an endless loop of money creation. Your original $10,000 gets multiplied through the system, generating thousands of dollars in interest for multiple banks. And you still get your $1. Look, before we get to the really dark stuff, the psychological traps they set for you, if you were getting value out of this, hit the subscribe button. I don't do fluff. I just do the math to help you stop getting played by the system. Join the community. Okay, let's talk about the fees. Because paying you nothing is not enough for them. They also need to actively punish you for being poor. Think about the monthly maintenance fee. It is brilliant in a sick sort of way. A bank will say, hey, keep $1,500 in your checking account at all times, or we charge you $12 a month. If your balance drops to $14.99 for one day, bam, $12 gone. Why? Because you did not give them enough free money to play with. And overdraft fees? Don't even get me started. They tell you overdraft protection is a service, a courtesy, like they are doing you a solid by covering your $4 coffee when your account is empty. But then they hit you with a $35 fee for a $4 transaction. That is effectively an interest rate of over 800% if you calculate it out over a few days. And the psychological analysis here is fascinating. Banks know exactly when you are most vulnerable. They process the biggest transactions first at the end of the day. Why? Because if your rent check clears first and drains your account, then those 3 tiny transactions you made later, the coffee, the gas, the pack of gum, all trigger separate $35 overdraft fees. 3 fees instead of 1. It's algorithmic extraction. They are literally running code to maximize the amount of pain they can inflict on your wallet legally. But why do we stay? If the interest rates are an insult and the fees are predatory, why do millions of people still keep all their money in these legacy banks? Status and fear. We are wired to crave familiarity. You see a Chase branch on every corner. You see their logo on sports stadiums. Your brain associates that physical presence with safety. You think, well, they're huge, so my money is secure. But in 2026, FDIC insurance protects your money up to $250,000, whether you're at a massive brick-and-mortar bank or an online high-yield savings account. It is the exact same government guarantee. You are trading thousands of dollars in lost interest for the privilege of walking past a glass building you never actually go inside. It is entirely irrational. Online banks right now are offering 3.5 to 4% APY because they do not have to pay for those glass buildings or the stadium naming rights. They pass the margin back to you. If you take $50,000, say you sold a house or got an inheritance, and leave it at a legacy bank earning 0.01%, you make $5 a year. Move that exact same $50,000 to an online bank earning 4%, you make $2,000 a year. $2,000 versus $5 for doing absolutely nothing except clicking a few buttons on your phone. So what do? You stop being loyal to corporations that view you as a line item. You treat your money like it is your employee. Right now, your money is working a sweatshop job for the bank, and the bank is keeping all the profits. You need to fire that bank. Move your emergency fund to a high-yield savings account, period. Keep a local checking account open if you really need to deposit cash, but keep the bare minimum in it to avoid fees. Route your direct deposit, pay your bills, and let the rest sit where it actually earns a yield. We live in an age where switching costs are basically zero. It takes 10 minutes. You just have to get over the psychological hurdle of breaking up with your bank. Because they are not your friend. They are a casino, and you are handing them the chips. I want to leave you with this thought, a quote from the old industrialist Henry Ford. He said, "It is well enough that the people of the nation do not understand our banking and monetary system, for if they did, I believe there would be a revolution before tomorrow morning." The revolution does not have to be in the streets. It starts in your own portfolio. By understanding the math and taking your capital back, I am Heisenbank. See you on the next one.